Hello and welcome to Moving Iron Tax Moves with Glen Birnbaum. Glen, we are getting ready for the show here, and you had just a laundry list of stuff to talk about today. But probably the one thing that we were talking about that I just would like for you to kind of touch on real quick because of the customers that I deal with and the stuff that they do
Yep.
is kind of some changes in the depreciation schedule with concern to leases.
Yep. Yeah, we'll definitely talk on the leases. But first, Casey, everything is just so hot right now. The IRS just released some proposed regulations last night again. So we've had actually three different sets of proposed regulations. So you might say, what are these things about? Well, you have the Internal Revenue Code, which is what Congress actually passes the tax law, right, and it gets enacted into the statute. But then the IRS can interpret certain things, provide more details of the code if Congress kind of grants them the authority to do this. So what the IRS has been doing here lately in the last 2-3 weeks has been issuing their interpretations, more specifics about how things work. So these are called proposed regulations. They're not final yet, meaning they're not officially, been approved, but it gives us a good indication of where things are going. So just last night, they issued some proposed regulations regarding the state and local income tax rules. And don't want to spend a lot of time on that, but basically, as a reminder, for the first time ever in 2018, you're going to be capped as an individual taxpayer. You can now deduct no more than $10,000 of like state income tax, property tax type stuff. So you're capped at $10,000. It's one of the big revenue raisers in the tax bill. So, however, like for donations, you're really not limited unless you get real high donations. Then it just carries over. So what some of these states were doing is saying, okay, well, how about a taxpayer we'll just treat this payment to the state as a donation, right? So it's not a state income tax payment, it's a donation. And then the state would give the taxpayer a tax credit back. So big picture, it would be a wash for the state, but the taxpayer would be able to deduct this payment not as state income tax, but as a donation. So it was basically a way around this $10,000 cap. And so these proposed regulations from the IRS kind of said, no, you can't do that. They disallowed it. So a number of states are actually fighting whether the IRS has the authority to do this. So just I think the big reminder here is that state income tax, property tax is capped at $10,000 for individual taxpayers. So we talked about that before. But again, this just came out last night. Just wanted to remind your listeners on that point. Okay.
I wish taxes were just a voluntary donation. That'd be nice.
Yeah. And that's what the IRS is saying. It's really not a donation, right? Because we're giving you this money back, right? So, but yeah, it was a convenient workaround. But it's going to go to court. I mean, there's going to be states challenging whether it's proper to prevent that. So we haven't heard the last of that. But so that just came out yesterday.
Right on.
So that was one proposed regulation just yesterday. The first proposed regulation that we haven't talked about yet, this happened about August 1st, as I recall, was this bonus depreciation regulations. And as a reminder, for the first time ever, we can now bonus depreciate used equipment. Before it had to be new equipment. And the nice thing about bonus depreciation, as opposed to like say what we called Section 179, was there was no limit on this. So you could be buying, the big companies could be buying equipment and able to write 100% of it off. But then again, that had to be new equipment. But for 2018 here, actually a little bit in 2017, now used equipment counts. Okay, so it's a pretty big deal. Used equipment counts. But what they said was, the law was like, well, you can't have used the equipment before. So the taxpayer can't have purchased the equipment before, can't have used it before to get this. So one of the questions that was out there is, well, what if I'm a farmer here and I'm leasing a combine, right? And it's based on engine hours. And so I'm not purchasing it, it's just a lease, based on maybe one harvest season. And I leased it and now I want to buy it. Is that going to be eligible for this bonus depreciation? Because have I technically used it before or not, right? So what these proposed regulations said was, as long as you didn't have a, quote, depreciable interest in the property, meaning you didn't really have it on your depreciation schedule, and you wouldn't if it was an operating lease, like, based on engine hours, you're going to be able to bonus depreciate it. So good news that, you could maybe try out a piece of equipment, lease in it, and then buy it later and still have all the same tax benefits as if you had, bought it initially. So maybe a trial run there. So that was the big thing on the proposed regulations for bonus depreciation. The other thing they said, though, which was nice, is if I'm buying out a partner in a partnership and there's a lot of equipment in that partnership, and I buy out their partnership interest, right? Maybe it's a 3-partner partnership, but I'm going to buy out a third of this interest, one of my partners, and there's equipment in there, I can bonus depreciate that purchase price, okay? Because, hey, I'm really buying the equipment, even though I'm actually buying a partnership unit. In case you'll remember, they know that partnerships are kind of like you're buying the underlying assets. You're not buying the stock like with an S corp. So
right.
That was nice too. That if I buy out a partner individually, I get bonus depreciation. But interestingly, if the partnership, again, let's assume that 3-partner partnership, if the partnership buys out that one partner, right? It's called a redemption. The actual partnership buys it out, not a particular partner. The IRS says the partnership does not get to bonus depreciate that purchase. So definitely, if you've got any transactions upcoming with partnerships, where you're indifferent whether the partnership buys this person out or the individual people buy them out, check with your tax person. And that, we should always say that on this podcast. I'm giving general overview here, not technically tax advice. You should always check with your tax advisor. But it does matter whether you're purchasing a partnership interest directly or whether the actual partnership is redeeming it. So bottom line is it's complicated.
That's kind of crazy that one part, if you're doing it same exact situation, but if you're doing it one way, it's fine. If you're doing it the other way, it's fine. So what would be an example of that? So if you had 3 partners or something like that, and 2 of them were going to buy out one partner, and then that partnership was going to buy out that equipment, like 3 brothers farming or something like that, and one brother is getting out or whatever.
Yep, exactly.
No, sorry about it, but you can't depreciate that out.
Yeah, you can depreciate it, but you can't immediately write it off in that first year or part of it off. So
you can do it like a regular, like a regular 5 or 7 year schedule.
You have 2 of the people that want to stay actually buy out half of the person that wants to get out, right?
Right.
That's one option. Option A. Option B is the partnership just buys out that person. In the end, you're economically in the exact same place, but the tax code treats it very differently. Now, I will say, Casey, that these are proposed regulations, and the IRS takes comments. There's a hearing. And so it could be that, they end up changing that and say, well, it doesn't really make sense, that if I redeem somebody, I don't get bonus depreciation. So that could be something that changes.
Yep. Okay.
So that's the second proposed regulation that came out in August, which was on bonus depreciation. Okay. Now let's revisit the big one that came out, 199 regulations. Okay. We'll get a little more details on this, talking about some specific equipment kind of purchase things that I wanted to touch on. We didn't have quite enough time last time to do that. So just as a reminder, this 199A is, about getting this 20% deduction, right? If I have $100,000 of income, for easy math, I actually might only pay tax on $80,000 because I get this kind of free $20,000 deduction, right? So it's a pretty good deal. If my income, and this is a pretty high limit still, if my income is over, as a married filing joint person, if it's over $315,000, I don't automatically get that deduction. There's a couple limits I have to work through, okay? So again, this is only if you're over 315.
Okay.
And it's 50% of wages is one limit. So I can pick the greater of these. So 50% of wages or 25% of wages plus 2.5% of the qualified property that I kind of have in service. My tractors, my grain bins, things of that nature. So I can pick the greater of them. So just to get a little more specific then and think through this, I then would need $40,000. If I have $100,000 of income, I would need to have $40,000 of wages, right? So my wages need to be 40% of my taxable income. Because then, right, $40,000 of wages times 50% is $20,000, and I need my wages to at least be $40,000, right? So again, that's only if you're over $315,000, but it certainly could come into play. So that's one angle. So hey, do you have wages more than that or not? Right, that's something we're really looking at on our clients. Now, if I don't have that much wages, then they did give us another option, which is 25% of my wages plus 2.5% of my qualified property, right? So I'm not totally done. So let's assume for some reason we don't have any wages, right? No wages whatsoever. What does my qualified property property need to be? If you do the math on this, my qualified property needs to be 8 times my profit. Okay, just trust me on this calculation, but 8 times my profit. So the bottom line is there could be incentive, and I guess there would be incentive for somebody to say, hey, I'm just going to go buy some equipment, or whatever it might be. I want to buy some equipment at the end of the year just to get my qualified property up, right, at a higher level. And then maybe I'll think I'm going to sell this equipment, shortly thereafter year end, and I've kind of got a workaround on this limitation, right? Well, the IRS said no. We're going to put in what's called an anti-abuse rule, and it basically says if you purchase this, this is important. If you purchase a tractor, let's say, within the last 60 days, so basically, roughly October 31st, right? So if you buy a tractor in the last 2 months of the year, and then you sell it in the first 2 months of the next year, okay, and you didn't really use it for like 45 days during that period, we're not going to let you be able to call that qualified property for that limit, right? So puts us kind of in a bind because we don't know, what the intention of, we don't necessarily check with people, hey, did you sell that tractor in January, right? We're doing the tax returns. But you should just know there is this anti-abuse provision that says, hey, if you buy it within the last 60 days of the year and then kind of sell it in the first 60 days of the year, you may not actually be able to work around this limitation. So they're always trying to do a little it's called anti-abuse. So, but obviously if you bought it, before that, and this is everything, you have to draw a line somewhere, right? So if I bought it on September 15th and I sold it on, March 15th, it would be okay, right? It's just the details. So just know that 60-day rule is out there. And again, it's just to try to prevent somebody from, hey, if they know I need 8 times, 8 times my profit needs to be in equipment. And if hey, I don't have that right now, you're kind of out of luck. So it's an anti-abuse provision.
Okay.
So they're all trying to think ahead, but it's a bright line test, 60 days.
So if I have a customer that comes in and says, man, I have a tax issue and I need to spend $50,000, right?
Yep.
Okay, great. What do you get him a little tractor or something like that, little $50,000 tractor in December, and if he turns around and comes back to me in February 15th, and says, hey man, remember that tractor you sold me?
Right.
I decide I want something different now. I'm gonna trade it back in. He could have a tax penalty.
Correct. Yeah, that's a great point. Even that's an excellent point. I hadn't thought about that yet. But even on a trade-in, that would hurt because we've talked about that before. That you can't do a trade-in. Now, here's the weird thing though, Casey. This is just 2.5% of the benefit I'm going to get is 2.5% of what I bought. So if I bought a $100,000 tractor, right, it's not a lot, right? $2,500. And then it's the tax rate on that. So this is kind of peanuts. But just to be clear, you could still buy a tractor. You could buy a tractor on, say November 15th. So in that 60-day period, and you can ride it, you can depreciate it, you can Section 179 it, and get the benefit in that year, and then sell it the following year. They're not actually preventing the normal kind of depreciation. You know what I'm saying? They're just trying to prevent this 2.5% thing, which is actually fairly minor if you think about it.
So in that case, he'd have.
So you could buy a tractor, write it off, sell it the next year. There's never been a prohibition against that, if as long as you had it for use. But so they put in a rule for this 2.5% thing, which is kind of minor. So it's probably not going to happen too much because most people are first concerned about being able to depreciate it, right?
Yeah.
Not this 2.5% limit.
So that's the exercise that I gave just a minute ago with the $50,000 tractor deal.
Okay.
He'd have to pay $1,250. That'd be his tax basis, right? And then you'd have to pay his tax on that. So if he's at a 100% of that. Yeah,
it's not even hardly worth talking about, is it? I mean, it's just minor. But the big thing is if he buys the $50,000 tractor in 2018, they can write that off, right, against their taxes. And then if you trade it off in 19, you would have to. That would be income, but maybe that's what you've created a deduction 1 year, income the next year. So it's kind of a weird rule because it's pretty small potatoes because it's only 2.5%. The depreciation I can deduct 100%, right?
Right.
This is like only 2.5%.
That's important.
That was going to be my next point on leasing. So broad strokes, if you are over this, and again, it's quite a bit of income still, $315,000. If you're one of those people that's over that, and that includes off-farm income. We're not just talking about your farm income. It's literally your taxable income on your return. So include, off-farm income, spousal income, whatever it is. Right now, if you really think about it, leasing, a piece of equipment on an operating lease is worse off than it used to be. So let's work through that. Why do I say that? Well, in both cases, whether you lease a piece of equipment or whether you buy a piece of equipment, eventually, over time, you're going to be able to write off the entire lease payment, right, as you pay it. And you're basically going to be able to write off the whole loan payment either through depreciation on the principal portion, and then interest, right, is deductible too. So either way, we get to eventually deduct this $100,000 tractor over time. Leasing is generally, as you pay it, whereas if you buy it with a loan, you can write it off in the first year. But let's factor in this new 199A thing. If you remember this, and this is why we get so complicated. So a tractor is it's a 7-year life, okay? Depreciable life if you don't write it off. But for this 2.5% rule, I get to get this 2.5% deduction, right? If I'm limited, right, I get to do that for 10 years. So it's a different life. So the bottom line is, if I buy a tractor and I don't sell it for 10 years, I get to write it off, right? Maybe over 7 years. So that's my $100,000 deduction. But then I get this 2.5% for 10 years, right? So 2.5% times 10 is 25%. So in effect, you could think of it, if I'm going to be subject to this limitation, maybe I don't have wages, very much wages, I'm in effect going to be able to depreciate this tractor 125%. Does that make sense? I'm going to be able to write it off initially, and then I get this 2.5% times 10 kind of gift. So if I buy a piece of equipment, I kind of get to depreciate it 125%. If I lease it, I only get 100%. Okay, so in theory, leasing is a little worse off if you're if you're not over 315,000, you would not care. But it's just kind of interesting to think about. There's some new rules now, like buildings and things. You actually get this deduction, this 2.5% for 39 years. So it's a very much longer cycle. But so there is a little more benefit to owning something if you're subject to these limitations because of that. Because it's qualified property, right? Remember that. I need my qualified property to be high. And if I just lease something, I can make the lease payment in December and I get a deduction for that, but it doesn't increase my qualified property. So again, all things equal, an operating lease is not quite as advantageous as it used to be. But remember, these 199A rules are set to sunset after 2025 is the last year. So, these things aren't around all that long. Who knows what might happen? So it's hard to, make decisions based on a temporary provision in the tax code. But that is what we have. So,
wow, that's kind of crazy that you could depreciate a piece of equipment out 125%. So if I buy a $400,000 combine,
yep,
I'm going to get an extra $100,000 worth of
20%, right, that I'm getting. That's why. So on a building, actually, a building is 39 years. That's awful close to 40. I'm pretty sure, right? Right, Casey?
Pretty
close to 40.
Pretty close.
1 divided by 40 years is 2.5%.
Yep.
And so really on a building, I effectively get to depreciate it twice. If this rule is going to be in place for 40 years, which I don't think it is, but so it's just they didn't give us, in theory case, they probably, it would have been more complicated. They probably should have given a higher rate on a piece of equipment, right? In other words, it's 2.5%, whether it's a building or whether it's a tractor, right? Probably would have made more sense to say, hey, a tractor needs a higher rate of return, than a building. If it should have been 10%, right? But they didn't do that, because that would have been more complicated. So this is just 2.5%. So for a lot of, for tractors that we might only, if we only own the tractor for 5 years, then we're only getting that 2.5% for 5 years. So it's probably not a whole lot, You'd really want to be be careful to you got to really push the pencil on this, but it's only 2.5%. It's not that big a deal.
Yeah.
And again, it's just my tax rate on 2.5%. So, but you've got to think through it. If you're going to be limited on this, you want to try to see either by do I need more wages, right, or do I need more qualified property to get this full 20%? Because otherwise, you're not going to get the full 20%.
So what about some of these larger entities, that have, like we have customers that have $5 or $6 million worth of just equipment, not counting trucks and trailers and so on and so forth. So they might be banging $10 million worth of stuff.
Yep.
That 2.5% is kind of a big deal at that point.
No, you're right. Yeah, and again, they're likely to be more over that 315,000. Yeah, so the real big players, the more sophisticated, they are probably pushing the pencil on this because every dollar matters ultimately. And you do know what the rules are now. And again, maybe in a few years they'll change. But so anyway, just remember that rule about the 60 days. 60 days before is 60 days after. But the big issue, you can still write it off and then recapture it later. So.
So if you're a bigger farmer like that, or a rancher or whatever, and you have a big pile of equipment like that, there's no really, other than the cash flow, how the lease affects your cash flow, right? There's no real tax wise. There's not a big benefit to leasing the equipment.
I think off the cuff here, I think that's a fair point because they've put the IRS, the Treasury Department has put preference on, hey, you've got to have qualified property, depreciable property. Land, as a reminder, land doesn't count, so land is not depreciable, so that doesn't count towards your basis. But yeah, you need 8 times, whatever if you know what your profit is, you need 8 times the qualified property. You're going to get limited. So, so yeah, I'm sure the big players are looking at this pretty hard.
Yeah.
So.
Okay.
Yep.
Wow, a lot to think about today, Glenn. As usual.
Always something. So, but please, talk to your tax advisor on this. We're giving I know we're getting into some specifics, but it's real hard to give tax advice. We're not giving tax advice here, but hopefully it's giving your viewers an idea, your listeners an idea of some things to talk about with their tax advisors.
Yep.
Coming up on year end here, so.
Yep. Last quarter of the year is fastly approaching, Glenn. So. Since we're heading into that time of the year and guys want to ask you some questions or maybe get some clarification on some of the stuff that we're talking about here, how would they do that?
The best thing, reach me, phone number here at Hienold Banwart is 309-694-4251, or you can also look me up on Twitter at Glen Birnbaum.
Okay. Glenn, always, man, you have given me something to think about here for the rest of the day, so I appreciate that, and we will talk again next week.
All right, Casey. Thank you.
All right. Thanks, bud.